presentation is really gonna start to annoy me. My day is interning.
For some reason.
Genuinely, how you met not too many pressure when you're from
Oh,你可以里面干3周。
Well, and they have a bunch of like equipment and trucks and like taking up 5
对，但是你的总时长要满24小时，其中8小时在 Spring Break 这个是肯定可以的，而其他就，但是在选地方嘛，就是看那地方有没有空位，有空位的进去。Library 他不是说文件说是不用12点，那就盖一个小时，但那给你加上还是加上也可以。
Okay, I reworked the, as I said, I reworked the section at the end of chapter 2. So if you're taking notes, I apologize for doing that, but every time I review things to get ready for a class, I always make edits to it, try to make it tighter, personally, best use for you. And then I debate myself whether I send it out or not, but I did on this one because I think I want you to understand the 197 amortization of intangibles. Very well for that, both anywhere in accounting and in tax. So I want to make that as tight as I could. So basically, I just reworked the ordering that we're going to cover these as well. Okay, so let's. There we go. Okay, so 197 intangibles. I'll restate a little bit of what we talked about on Monday. We're looking for when a business purchases a collection of assets. Right? We only do 197 intangible tax for buying assets, and I have to buy a collection of assets. If I buy a single asset, there is not going to be 197 unless it's itself 197 intangible. But I am not going to have 197 amortization. So I'm looking to buy like a business, the assets of a business, or a division of a corporation. If I buy stock is non-amortizable. My basis sits in the stock, okay? Not in the underlying assets. Okay? And I'm doing this for a single purchase price. So then I must allocate the purchase price amongst all of the acquired assets to determine each asset's initial tax basis. I do that using a residual method. So I make a purchase price for the total collection of assets, and I start spreading that amongst the assets. I do that in a residual manner based on classes of assets. This is similar to, I think, what happens in financial accounting as well, but it's very prescriptive in tax. Code section 1060 tells us this. But I basically start with tangible assets, and I go to identifiable intangible assets, and then I go to other intangibles that I not necessarily can identify, and I end up with goodwill as my point number at the end. Okay? So, intangible assets, we're going to be thinking about customer list, patents, trademarks, trade name, covenants not to complete, going concerning goodwill. All of that bucket of assets, we're going to refer to as section 197 intangible. Okay? 197 is just the code section that tells us how we deal with the cost recovery over time. So, it's very, and remember, I put in the bubble here, we don't have tables. Don't do accelerated depreciation. So I'm assigned a recovery period for tax purposes of an arbitrary 15 years. It doesn't matter if my customer list expires after 5 years. It doesn't matter if the customer list is, for some reason, it's good for 50 years. Tax code says 15 years is your recovery period, and it's straight line. It's really simple. We don't need a table for that. And the reason the government chose 15 years, remember I told you there was a tortured litigation history on this issue, and the government said, okay, we're tired of fighting about this. You win, you get the litigation, but it's over 15 years straight line. Okay? So the portion of any purchase price allocated to a 197 intangible in an asset acquisition, amortized straight line over 15 years, for financial accounting purposes. I have purchased goodwill, so I have this collection of assets, I have a residual purchase price allocation, and I have a goodwill amount. Amounts paid in excess of identifiable assets is goodwill. For accounting purposes, right, I do not amortize that. that sits on the balance sheet as goodwill, I test that periodically for impairment, right? Meaning, what I bought, is it still worth what I paid for it? If it went down in value, I have to write down the goodwill, it's impaired for tax purposes. So I end up crediting goodwill and credit or debit expense. Okay? But if I do not have an impairment, it just sits on the balance sheet forever. Tax purposes, I'm writing it off, 15-year, writing it off, I'm deducting it, 15-year straight line. So right there, you know I got a book tax difference. I got different standards on how I address cost recovery of this thing. The other point I want you to make sure you're aware of is self-created as opposed to acquired goodwill. So I create my own goodwill, like Apple every day working on their products, right? They're creating their own goodwill. They didn't buy it, self-created it. That's not amortizable for tax purposes, right? So I think they're a $4 trillion market cap. However much of that in a residual calculation would be goodwill. That might be a big number, but it's not amortizable. We're talking about purchased goodwill. Okay? Keep that in mind. Okay, let's do 221 is Abigail.
Okay, so on January 30th, 2025, Teton acquires a competitor's assets for $350,000.
So let me pause you there. If I change this from assets to stock and give you all this other fancy information, that's just a red herring. You have to purchase assets, right? So that's the only way you get into this. If you purchase stock, your basis is in the stock, not the asset. Okay.
Out of the 350,000, 125,000 is allocated to tangible assets, and 225,000 is allocated to 197 intangible assets, which is 25,000 for the patent, 50,000 for the customer, and 150,000 for goodwill. For each of the first 3 years, Teton would deduct 1/15 of the basis of each asset as amortization expense. What is Teton's accumulated amortization and remaining basis for each of the So we would do 1/15 for each year for 3 years, so that's 3/15s, which is just 20%. So we would separate the intangibles, and then the initial basis for the patent is 25,000, and then 20% of that is the accumulated amortization, which is 5,000. For the customer list, the initial is 50,000, and then 20% of that is 10,000. And then for goodwill, 150,000, and the integrated amortization is 30,000.
So very straightforward. You don't need a table for that, right? And you might ask yourself, well, why do I look at them independently? Well, what if I sold the patent in year 5, right? I want to know kind of what is the patent. So it's better to capture this information on the day I start recording this stuff than just having it globbed into a big combined number and then having to go back and write it out. I put it here in the bubble as well. The purchase price allocation for tax purposes usually needs to be agreed between the buyer and the seller. The reason because the seller is selling assets, and we're going to talk a little bit about property disposition in the next chapter in a moment. And the seller might want to skew purchase price to certain assets because they get a different result. The government doesn't want to be whipsawed by the buyer treating it one way and the seller treating it another way. So they at least want consistent treatment at the end of the day, that they don't get whipsawed on one transaction by 2 parties looking at it differently. And so this is usually agreed to by the 2 parties as to how we're going to treat the purchase price allocation amongst these. Okay, thank you. Okay, I think this is a really interesting taxes in the real world, because I'm a sports nut as well. And understanding how this came about was, I think, pretty interesting. So we're probably, think about this, we're probably thinking about this as the owners of these sports franchises owning these via flow-through entities, LLCs or partnerships or something like that. You hear a lot of times there's a majority owner. That's because there's probably a bunch of partners into the ownership. And so this is where that would happen. It could be wholly owned, but in a branch situation where everything, what I'm getting at is the results are flowing through the owner, because the premise here is, why are the owners paying such a low rate of tax? These are typically billionaires Why are they paying such a low rate of tax at the end of that? So this article, data revealed that tax rates of some of the sports team owners and compared them to the tax rates of the players and even some stadium employees. Their analysis showed that the owners often paid the lowest tax rate. So they're talking effective tax rate from their income versus the actual tax they pay. The rate of tax they pay is going to be high, but the base is probably low. This is driving down the base. So the second part I underlined, the answer relates to how the price of a sports franchise is treated under the U.S. tax code. A sports team's most valuable assets are generally its TV and player contracts. These assets can represent upward to 90% of the team's value. When the franchise is acquired, right, you see this like every year some franchise changes hands. Somebody is the purchaser of it, the purchase price is allocated to the team's assets under that residual method we just talked about. Sometimes there's not a lot of hard assets. Now, some of these teams don't even own the stadiums. Cities own the stadium, or states own the stadium. So what are the value, when they're paying billions of dollars for these things, you start doing this residual calculation, what hard assets does it really go to? They're saying here, it doesn't go to very many hard assets. It starts going to intangible assets for this outsized value of why somebody's paying for all this. It's because of the TV revenue, the ad revenue, the Super Bowl revenue, all this stuff is just, the dollars are staggering, okay? So we're allocating the purchase price and then subjecting to depreciation, or more importantly in this sense, that's amortization rules. Under 197, anything I would fall to this bucket in the residual computation is going to be a 197 intangible, and it's amortized and deducted over a 15-year period. So think of somebody, the Mets owner, his name is escaping me, but he's one of the, Steve Cohen, I believe. He's like a private equity guy. Billionaire, owns the Mets, probably got a zillion different business investments, but he's got a Mets franchise that might be structured as a flow-through. Why so? Because he paid billions of dollars for the New York Mets. He's well advised. A lot of that purchase price was allocated to 197 intangibles that creates deductions over a 15-year period. If I take billions of dollars over a straight line 15 years, it's still a lot of money. That flows up to his tax return with all his other stuff, lowers his ultimate tax paid to something very low, which you wouldn't think a billionaire would be paying that least amount. That's what these authors are in this article are. I found that fascinating. I didn't know that, but it makes sense when you think of the residual allocation, right? There's only so many baseball bats and things like that. I'm sure he doesn't own the stadium. And so it's like, why did you pay X billions of dollars for the New York Mets? Well, you're going to allocate that to the assets, and it's going to give rise to these annual deductions that are offsetting other things. I think the One Big Beautiful Bill Act of last year was going to address this as well. I think there was a provision that was introduced to limit the amortization of purchase price on sports franchises, but it got dropped at some point. Drop when somebody calls somebody and says, I would like this job. Sometimes that happens. I'll log it to me. Okay, so that's 197 intangibles. Collection of assets, not stock, and then that what's left over at the end of it. Okay, research and experimentation expenditures. This sometimes goes by R&D, interchange. Research and experimentation, R&E, with R&D, usually they're talking about the same thing. It's the white lab coats, the people that are doing the experiments and developing the next layer of products or the next generation of products. So to stay competitive, businesses often invest in activities they believe will result in innovative products or significantly improve current products or processes. These typically include costs of research labs, including salaries and materials, all that process. Some industries this is going to be higher. It's pharma. This is a major expense. Right? They're trying to develop the next blockbuster drug. It's high tech, same thing, but in the gadgets that we all like, we're trying to develop the next one of those things. So these can be significant expenditures. Beginning in 2022, taxpayers were required to capitalize R&E expenditures and amortize them using straight line method over 5 years much to the chagrin of the business community. Why is this in 2022? 2017, we had the Tax Cuts and Jobs Act of Trump 1.0. We lowered the tax rate from 35% to 21%. That has to be revenue neutral in 10 years. What did they do? In that law, they said, even though they were in 2017, they said, beginning in 2022, when we get there, R&E expenditures are capitalized and amortized over 5 years. Meaning I'm pushing out your deduction for 5 years instead of it was always deductible current. I think when you were in 2017, corporate America was very happy that the tax rate was going down by 14 percentage points. Great. I'll deal with 22 when I get to 22, and that's 5 years away. Well, you get there, right? And so this was a constant thorn in the side of corporate America. They were making arguments that you're going to make me do R&E activities outside the United States. You're going to make me employ people outside the United States to do this. You're going to make me have ownership of intellectual property that is a result of R&E outside the United States. Is that really what you want to do? Of course, politicians will say, no, that's not really what we want to do. We'll fix it. They fixed it. If you believe it's a fix, they fixed it in One Big Beautiful Bill Act of last year. So what they did is they restored it back to 100% if you do the R&E activities in the United States. So this is very similar to the Republican view of doing things in the United States. So if you're a U.S. multinational, you do the R&E in the United States, 100% deductible, all that research expense deductible in the current year tax return. If you choose to do it in one of your foreign subsidiaries, it is capitalizable and amortizable over 15 years. That's a carrot in the stick. Trying to attract you to do this in the United States, create the intellectual property in the United States. So this was a big change and a favorable one in the One Big Beautiful Bill. Okay, so I just went through that. So the U.S. R&E immediate expensing, if you do all of that activity in the United States, it gives rise to those expenses. So we had transition rules because we had some companies who were in the middle of that 5-year amortization. So they got transition rules between 2022 to 24 where you have options. Do you want to immediately deduct the remaining unamortized costs from the prior rules? So again, this is great when they have all these changes. It's frustrating for business, but it's great for advisors because deal with all this crazy transition stuff that we do. And then foreign R&E expenses are capitalizable, as I mentioned, and amortizable. Yes, Con.
How did like the Inflation Reduction Act, like in 22, like how did it kind of affect the credits? Did it enhance credits for like, you know, an energy company or like a healthcare company, or did it make it even harsher for these companies with this section of the Tax Jobs Cut Act with it too?
Yeah, the Inflation Reduction Act, that was a smaller piece of legislation, but it came online in the Biden administration. And it did various things because we had inflation going on, and so they were doing things that they thought would try to quell inflation. But again, don't get caught up in the name of legislation. Sometimes that's very political. It doesn't have any indication of what is actually in the text of the bill. And so the Inflation Reduction Act did lots of things. I think one of the more important things it did is it actually subsidized the creation of chip manufacturing in the United States. So that was a big thing, and because that's a long timeline to do that. But you actually, I think you are seeing evidence of that. Taiwan Semi, one of the biggest manufacturers, is building a facility in Arizona, I believe, and they're looking at another one, and these are like billion-dollar investments. And so those types of activities are going on. I think what you also saw is a gradual reduction in kind of the environmental credits that started in the Inflation Reduction Act, I believe, and it was really hammered in the One Big Beautiful Bill Act. Like the EV credits went away, solar credits went away. These are things like the Republicans don't want. So they kill those things to pay for them. So it's a great question, and they're always tweaking with the credits and trying to remove those things, and in the mindset of what the budget. Always. Okay. The third area is patent and copyright, so this is also amortizable assets. So how the cost of a patent or copyright is recovered annually for tax purposes depends on your method of acquisition. If you buy a patent or copyright singularly, one patent or one copyright, you amortize the purchase price over the remaining useful life of the asset. So if it's in existence and you buy it, then you look at it, how much longer is that patent or copyright good? So if you think about this in pharma space, if pharma company, they're always buying other drugs in various stages of pipeline to kind of support their own business. But if you're buying a patent and it's in year 5 of a 10-year life, then you're going to amortize it over the remaining 5 years before it goes. Most likely. That's when you buy specific asset only.
When you report the patent, or at least the value of it on your financial statements, do you use it with the original purchase price where you bought it from, or is it adjusted to what its value now? So for instance, if it's a copyright thing that's like very long, or like in the multiple decades, would you report it at the original purchase price or whatever it's valued at?
It's a good question, and you guys ask me accounting questions. I'm a lot further away from accounting than you guys are when I took classes, but I know enough to be dangerous and stay current as I can. But from an accounting perspective, it gets recorded at purchase price, right? And then it will be maintained at purchase price unless it falls below that. Right? We can't carry assets on the balance sheet above their fair market value. We have to write down assets if the value goes down, but we don't write it as it goes up. So it's kind of a one-way street, if you will. And I think that's because of the conservative element of financial statements, right? We don't want to overstate assets. We have evidence that they go down, we have to write them down. But so the impairment of goodwill is an example of that, we have to write it down. But if I have a wildly successful acquisition and my goodwill is worth some multiple of what I paid for it, I don't write that up in the financial statements. So it gets carried at that historical cost unless it goes down. Okay, so let's say I acquired the patent or copyright as part of a business or a collection of assets. That goes back to 197, he's going to fall into that bucket. So now I have 15-year straight line, right? So it gets caught up in that. I don't look at its remaining useful life. It just falls into the 15-year straight line of assets. And if it's self-created, so this is apart from what we talked about on 197s. Self-created goodwill, never amortizable. Self-created patent or copyright, so I'm the one who creates. So if I'm the drug company and I create the patent and I get the patent, then I amortize it over the legal life of the asset for tax purposes. Right? So if I get a patent and whatever the drug is good for before it goes off patent and becomes generic, I would amortize that cost over that period of time. And just note that for such costs, I believe for financial accounting purposes are largely expensed. So you can automatically see here for some of these things, I got different lives, different recovery periods for tax than I do for financial. That's going to get into our tax accounting stuff that we're going to do in chapter 6.
Does it fall under the 15-year rule, or it can be expanded 20, 25 years?
So
The
if it's self-created,
Yeah.
it would fall under however long that's legally the legal life of that copyright or patent. So it could be longer than 50.
Or longer than that?
I don't know. I didn't do a whole lot in the pharma industry. I don't know what the normal going grade is for a patent on a pharma drug.
So according to 197, technically self-created patents are not intangibles?
They are, so self-created, so I didn't purchase it, right? So self-created is I created it. The result of my R&E activity said, oh, this is a great patent, let's go get it patented. And then whatever I had that cost associated with it, that would be amortized over the legal life of that asset. So it's just different between, how did that asset come to be? Did I buy it or did I create it? Okay, last topic for amortization is organizational expenditures and startup costs. So think of organizational expenditures. Those are those that are incurred to form and organize a business. So A corporation or a partnership, so you have legal fees, you have filing fees, anything to kind of get that business entity up and running from a legal perspective prior to starting the business. That's going to be your organizational expenditures. Compare that to startup costs, which are similar, but those are incurred to start the business. So costs associated with investigating the potential acquisition of a trade or business, a location for a trade or business, the training of employees before the business begins operating, right? You can't just like snap your fingers and the business gets running. There's a degree of business expense that's there for just getting up and running before you actually open the business. Those are technically startup costs. So you are allowed to immediately deduct $5,000 of organizational expenditures and $5,000 of startup costs, with any excess amounts being amortized over 15 years. Okay, so if you choose to spend more money than what's immediately deductible, you can do so. The government just, again, doesn't partner with that on a current year tax return basis. Make you capitalize it, amortize it. And kind of shockingly, over 15 years, a lot of these smaller or shorter than that. The availability of immediate deductions is subject to a dollar per dollar phase out that begins at $50,000. So if you're spending a lot of money on your startup and organizational expenditures, then the government's going to start haircutting that. The excess expenditures are amortized over 15. So let's do a couple of examples here. So 222 is Lauren.
Okay, so suppose Teton was organized as a corporation rather than a sole proprietorship. This is because sole proprietorships cannot deduct organizational expenditures. So Steve paid $35,000 of legal costs to draft the corporate charter and articles of incorporation, $10,000 for accounting fees related to the organization, $7,000 for organizational meetings, $5,000 for stock issuance costs, and $1,000 for state incorporation fees. What amounts of these expenditures qualify as organizational expenditures? So the qualifying organizational expenditures only include the legal drafts to draft the legal costs to draft the corporate charter and articles of incorporation, accounting fees related to the organization, organizational meetings, and the state incorporation fees. So the stock issuance costs are not considered qualifying expenditures. So you add those up and you get $53,000.
Yep. So I don't know the rationale behind why stock issuance costs are not part of the organizational costs. They might be otherwise deductible under trade or business expenses, but they just technically don't fall here under organizational expenditures. And so we got 53 total here. The question is, the client came to you and they just was a startup and they incurred this. What do I do with this amount? And that's what we'll look at. Okay, 23 is Allison.
Suppose Teton is a corporation and wants to maximize its first year organizational expenditure deduction. As described, Teton incurred $53,000 of organizational expenditures in year one. How much of the organizational expenditures can Teton immediately deduct in year one? So usually you're allowed to do $5,000, but since they exceeded the threshold by $3,000, $5,000 minus $3,000 is only $2,000, and then the leftover $51,000 would be over.
Yeah, so it's greatly recoverable over a great period of time, which kind of shocks me again. But, and these numbers, to the best of my knowledge, I don't think are indexed for inflation. So obviously, 50,000 5 years ago is not what 50,000 is now. Okay, last topic, real quick, depletion. Depletion is a cost recovery method, but it is solely related to the natural resource space. So think of things that come out of the earth are thrown through the earth. So coal, oil, timber, those types of things. There are companies that are involved in these activities, right? Their outlays are not on machinery and equipment necessarily. A large chunk of that is the earth and how they get this type of activity, are these types of properties to be able to engage in these activities. So depletion is the method they use to recover their capital investments in the natural resources. Okay, I just bring this up because again, you might run into a professional at some point that talks about depletion, you might be like, what the heck are they talking about? They're talking about depreciation, but in a natural resource space. That's all they're talking about. Okay? And you complete annual depletion under a cost depletion or a percentage depletion. This is where I was saying, if you go into these meetings, they start talking about the nuances of these things. What are you guys talking about? But that's how they're recovering their cost for the outlay for the natural resource. Cost depletion is just estimating the number of recoverable units, so tons of coal or barrels of oil in the ground. You have engineers involved in this, right? This is not accountants and tax people doing this. Somebody is estimating what's in the ground that remain at the beginning of the year and allocating a pro rata share of basis to each unit. You multiply that amount by the number of units sold during the year, and that is your cost depletion for the year. Percentage depletion, which is a secondary method. What people do is they run both methods and they choose one to get the best. I don't expect you to know this. I'm just wanting you to understand if you encounter this in your career or from classes and from classes you will get to know what the. Okay, so we did lots of things here. Tax basis for cost recovery is typically the purchase price, the cost. Certain instances, it could be other than cost, depending on how the asset was required. And then just think about depreciation rules. I have the basic rules, that's the makers and the tables. I had slides in there that give you the 5-step process. Practice those examples. You get those right tables, intersection of the column and the row gives you the percentage and you're there. We have special rules. That's the 197 immediate expensing, 179 immediate expensing, sorry. And then the bonus depreciation rules as well. And then we have limitations. That's the listed property and the luxury automobile stuff we talked about and the amortization stuff we covered today. Okay, so that's the cost acquisition, property acquisition and cost recovery that we get over time. And that is agnostic to what type of business entity we're in. You have to be in business. Partnership, corporation, S corporation. So the last topic we're going to talk, our last chapter I believe we're going to talk about is chapter 3, which is agnostic across business entities as well. And we're on the other side of the property life cycle, which we're disposing of things. Yes, ma'am.
Did you upload those? Because on the announcement you said chapter 3, but the link was chapter 2.
Ah, my fault. Let me bear with me. Thank you. One second.
Okay, I see it.
Okay, so we're on the other end of the life cycle, so we already have the property and we now have disposed of it. So we're gonna talk about amount realized, adjusted basis, realized and recognized gain or loss, character of that gain or loss, which is important, and the tax deferred transactions. My goal is to get through character today. Get that far. Those of you that were in taxation of individuals, some of this is going to be terminology that you've heard before, because whether a person sells property and the computation of their gain or loss is no different than when a business sells it. The only element that's going to be there is depreciation, we just talked about. You don't take depreciation on assets you own as an individual unless you're using them in a business. Business will take depreciation on that. So hopefully some good concepts that'll refresh some of your memory here, and then we're going to take it to another layer because we're going to get into the character of the gain or loss. Okay. So we're going to be talking about property disposition, which can take the form of a sale, which is what we normally think about when we're disposing of property, but it could be an exchange, i.e. I give you a piece of property in exchange for a piece of property from you, not cash. Or it could be any other type of disposition, but I've had a exchange, somebody's given up a piece of property for something else. All of that will be applicable here. We are going to focus on the disposition of tangible assets, but the same principles apply to intangible assets. So we're going to be dealing with hard, tangible assets that we can touch, but if it's a patent or copyright, the same principles are going to apply. So this taxes in the real world article, I think, is a good one. I don't think people are focused on this as much, and I'm sure some people, hopefully nobody in this audience, has some latent tax issues on things they've done in the past. But in February of 21, Tesla announced that it would accept Bitcoin as payment in exchange for its products. Okay. Since then, lots of companies have announced that they would accept cryptocurrency as payment. Right? Completely fine. That's a business decision. The IRS treats Bitcoin as property and not U.S. currency. I put U.S. in there because it can't be just currency, because there's other denominations in the world, and they are also property. The only thing that is not property for purposes of disposition is U.S. currency. We're dealing with U.S. taxpayers, U.S. tax filings. When I spend $10 on lunch, I don't have gain or loss in my $10, because my tax position is in U.S. If I use $10 of euros, I have a tax event when I give up the euros. I disposed of property, and it's not U.S. currency. Same thing with crypto. So what this is, this article is pointing out is, if I used Bitcoin to buy my Tesla, then depending on when I acquired that Bitcoin, at this point in time, Bitcoin was going up from left to right. Now it's going down from left to right. But at that point in time, I would have a gain in the Bitcoin that I used to make the purchase. So that would be reflected on my tax return. And they're saying, if I bought it in this hypothetical within 1 year and I disposed of it, it would be a short-term gain. And if you recall from individual income tax, if I have a short-term capital gain, that is taxed as ordinary income. If I'm in a high enough tax bracket, that's at 37%, where it caps out. So it's posing that your purchase of your car is much higher than what you thought, because you used an asset, you disposed of an asset, piece of property that was appreciated, and you have to pay tax on that as well when you make this acquisition. So just keep in mind, gains on an app, all that type of stuff, under the eyes of the law, those are property transactions. You do that all you want, it just makes making your tax return very difficult. So just keep that in mind. Okay, taxpayers can dispose of property in many ways, as we talked about. Sale for cash, exchange for non-cash property. You can donate it to charity. You can abandon the asset. The asset is not worth anything anymore. Right? That happens sometimes with parcels of land. Somebody just says it's not worth anything to me anymore. I'm just going to forego my ownership of that. No matter what method that is accomplished, every asset disposition constitutes a realization event. So remember, realization is the economic transaction. Nothing's been on the tax return yet, but there's been a transfer, an exchange, okay, for tax purposes. And the amount of the realized gain or loss on a disposition is simply the amount realized less the adjusted tax basis, right? Doesn't matter how big of a company I'm dealing with, how sophisticated what the asset is, what was your amount realized, what was your adjusted tax basis, that's your realized gain or loss. Okay. The amount realized from the disposition of assets is anything of value received by the seller, less your selling costs. So typically that's going to be very easy because that's going to be your cash. You dispose of the asset for cash, but it could be the value of the non-cash property you received, such as marketable securities, a note issued by the buyer, but the buyer didn't pay you cash, but they're saying, I'm going to deliver an instrument to you in the form of a note where I intend to pay you in the future. That's value, right? That's amount realized. It could be cryptocurrency or any combination of the above, right? If it's a collection of things that they gave you, all of that counts as amount realized. So think of cash received plus fair market value of non-cash property received, buyer's assumption of the seller's liability. So if I have a liability associated with an asset and the buyer agrees to take the liability off my hands, my personal balance sheet or my business balance sheet in exchange for and along with the asset, that's amount realized, right? I'm economically better off by no longer being liable for that liability. That's amount realized. And then I get to subtract my selling expenses to get to my amount realized. Again, this is a fairly simple computation, but it's for every property disposition out there. That's why you saw it in individuals, that's why you see it in business. And that liability assumption, that's typically what you're going to see in real estate. Because a lot of times, real estate is debt associated with the real estate. So a lot of times, the title to the real estate, the ownership of the real estate, can change hands along with the liability. But that constitutes proceeds or amount realized to the seller. Okay, example 3 on our first one. This one, Jacob.
So Titan wants to upgrade its manufacturing machinery, which is old and it's wearing out. On November 1st of the current year, Titan sells the machinery for $230,000 in cash and marketable securities valued at $70,500. And he also paid a broker $500 to find a buyer. How much is his amount realized on the sale of machinery? So you add the cash and the marketable security, which is $300,500, and then you subtract the selling expense, which is $500 to get you.
Anything of value less any commission that you had to pay or selling expenses to be able to get to that. Right? And don't get confused because the marketable securities on the other side of that transaction, that was a disposition for that party, right? They disposed of the marketable securities. That doesn't. When you get a question or you have a client, what is the question being asked? Are you being asked what is the amount realized? Well, that's the seller's question. I'm asking what was the buyer's implications as well. Well, they paid cash, having gain or loss in U.S. dollars, and then they disposed of marketable securities. That's the exact example of that Tesla Bitcoin transaction. They used non-cash to buy the car. This person used marketable securities to buy this equipment. Okay, so the second thing we need to know is the adjusted tax basis. This is the initial basis. We started out in the prior chapter. Usually cash, but it can be in special circumstances other than the amount paid. So think of gift, inheritance, those types of things we talked about. Reduced by accumulated depreciation. So this is why it's adjusted tax basis, right? It's initial basis less what you have already recovered through taxable income by virtue of taking depreciation deductions. The reason that reduces your basis is because you already got benefit of that. You took that depreciation deduction over time through taxable income. So the government's already saying, like, that's gone. You don't get that again on sale by having it caught up in basis. Okay? Because businesses typically take accelerated depreciation, remember those makers tables we were in? The front years were higher percentages than the later years, accelerated. Bonus depreciation, section 179, immediate expensing, very, very accelerated, right? So they are accelerated compared to what's taken for financial accounting purposes. Adjusted tax basis is typically less than book basis at any point in time, right? Because I recovered the cost faster for tax purposes than book is recovering it. Okay. What that means is I typically have a book tax difference for my property in my business. And that usually has a deferred tax liability treatment for such difference. We're going to cover that in the next chapter we go through tax accounting, but I just wanted to introduce here that this is one instance where the an item has a different basis for tax purposes than for book purposes because of the depreciation methods we utilize, and that book tax difference is what we're going to focus in on chapter 6. Okay. So 3.3 is, anybody do 3.3? Sign up. Anybody want to sign up?
This is an example of 3.3, the profit statement. It's the determined realized gain or loss on sales. Each time is calculate the adjusted basis of the machinery is sold. In example 3.1 for $300,000. Teton originally purchased the machinery for $610,000 3 years ago. For tax purposes, Teton depreciated the machinery using the MACR's 7-year recovery period, 200% declining balance method, and half-year conversion.
So that is just so for your, that is table 1 from the last chapter. If we determined that that was 7 years, and we'd have found it in that table 1, we would have got to these percentages that we used in this. Okay.
And then if you just walk through 1 through 6, the initial basis is $610,000 because that's what Teton originally purchased the machinery for 3 years ago. And then you just walk through the table and amortize years 1 through 4. Get the values for 2, 3, 4, and 5. And then you add up all those values to your depreciation, and that's going to be your adjusted.
Yep. And the only nuance here is year 4 was the year of disposition. And remember, we had that special rule that you get half of the year, no matter when you dispose of it in that year. So they were entitled to $72,000 of depreciation for that year, and they get half of it because they sold it in that year. And so I've deducted all of those expenses through my taxable income. So I've lost, I don't want to say lost, I've recovered that basis already. So what's left to recover is $228,000 on the final disposition. Okay, so this probably looks familiar to those in taxation of individuals, but for any property disposition, I compute my amount realized, my adjusted basis, and then those go into getting my realized gain or loss. These are just restating those formula or the calculations we talked about before. Amount realized, cash received, fair market value, liability assumption, less selling expenses, my amount realized, adjusted tax basis, initial basis, however I determine it, less accumulated depreciation, I subtract that from amount realized, that is my realized gain or loss. Doesn't mean I'm paying tax on that. That's my economic transaction because I affirmatively did something with the property. Right? How is it recognized? Simple. Did it get onto the tax return? Did I look at that realized gain or loss, go through, is there any exception that would make this where I do not have to put it on my tax return? Okay. The default rule is I'm going to put it on there unless something tells me it's not on there. So the vast majority is on there. Certain circumstances I may be allowed to defer recognition of certain gains or losses or permanently exclude. So when I defer recognition of a realized gain or loss, that just means I'm not putting it on this year's tax return. It doesn't mean the realized gain or loss is forgiven or excluded for all time. It just means not this year. Right? When we get to tax deferred transactions, which are very lucrative for tax advisors, because people like to, one, you'd like to exclude tax or gain, but if you can, second best is defer it. And so there's lots of deferral opportunities where you push that future recognition out into the future. But I just want you to think of what is actual deferral. It's not an excuse or forgiveness of tax, it's just not this year. This is not the year we're tax. Okay? You have to be careful as well when you meet some of these tax deferral rules, which we'll talk about next week. They can work on deferring the recognition of losses as well, right? Not every property disposition is a gain. Sometimes you lose on your purchase price and amount realized and your adjusted basis. Sometimes it puts to a loss. If it's a loss, you prefer not to defer losses. We prefer to recognize losses, right? But many times the rules are what they are. If you fall within the rules, your loss can be deferred, just like the gain can be deferred. So the moral of that story is they told you the rules, don't fall within the rules, so you can recognize the loss. Right? You only defer it if you meet the requirements for deferral. If you don't meet the requirements of deferral. Okay, so the character of the gain or loss. So after we've determined the amount of the gain or loss that is realized and then recognized because it's on the tax return. Okay, so now we're dealing with the gain or loss that we're going to report on the tax return. I need to know the character of that gain or loss to determine the tax effect of that recognition. And I put here in the bubble, this is, I found common where people jump ahead of the game here. The character of a gain or loss does not impact the amount of the gain or loss. Okay? It's just, how do we treat it? You have to do this calculation, right? What's realized, assess whether there's any deferral opportunities or exclusion. If not, it is recognized. That is the amount. The amount doesn't change when I get into determining the character. Okay? So don't go back and revisit the amount. You're just trying to characterize it. So the character of a gain or loss is important as it determines how the item of income or loss impacts your tax liability. Every gain or loss is ultimately characterized as either ordinary or capital. Ordinary is, just think of it as regular or normal, if you will. Capital is a specific type of assets. You're either capital because of the virtue, by the nature of the asset. If you're not capital, you're ordinary. Okay? You see this is pretty straightforward in the business context as to how we treat ordinary versus capital, but with one specific difference. A capital gain or loss is further characterized as short-term or long-term. You probably remember that bifurcation from taxation of individuals. Same rule here. It's an arbitrary. Did you hold it for greater than 1 year or less? If you bought it and sold it within 1 year, it's short-term. If you bought it and sold it, it's greater than 1 year, it's long-term. The importance and the benefit of short-term and long-term is different for individuals and businesses. So the reason we talk about it here is because some of our businesses are flow-through, right? We have partnerships and S-corps that flow through. I might have individual owners that I got to deal with. So short-term, long-term is important in that context. C corporations do not care about long-term, short-term. Why? Because I have one tax rate, 21%. Okay, I think this is an important chart. I tried to pull it all together because again, this is one of those areas where I think you can get lost in characterizing a bunch of things and then why is it important, those types of things. So, the character of gain or loss is important because ordinary gains and losses are treated different than capital gains and losses, dependent upon the profile of the taxpayer that is recognizing the gain or loss. Okay? We're talking about business entities here, so I put individuals here. Why? Because they could be the owner of a flow-through business entity. Partnerships many times have individuals as partners. So characterizing the business's gain or loss as long-term, short-term, ordinary capital, those of you that were in taxation of individuals, you gotta know that to put that on the individual's tax return. It's gonna tell you what's the rate of tax on that income. And then we have corporations, which are separate taxpayers. Okay? So let's just spend some time on this, because I want you to all to follow along. So, the character is the top part here, and I have ordinary or capital, and within ordinary capital, I have income, loss, gain or loss, and capital. Right? That's my two options under each one. And then I have individuals and corporations as my rows. So if I have ordinary income, and it's recognized by an individual, so I'm in this box here, that's taxed at ordinary marginal tax rates, right? And I have a graduated tax system in the United States. It goes up to 37%, okay? So I need to know if it's ordinary income, if I have individual owners of a flow-through entity. Individual owners of a corporation, it doesn't matter. There's no flow-through, right? The corporation is the taxpayer. Right? So again, staying on the individual row, if I have losses and it's ordinary, that's important because now I can offset ordinary income, which is typically salaries and interest and dividends that an individual receives. If I kick up an ordinary loss, then I can offset that income. So I need to know that. If it's capital in nature, received by an individual, if it's long-term gain, that's taxed at preferential tax rates. 0, 15, and 20, which is less than the marginal tax rate, top marginal tax rate for ordinary. If it's short-term, it's taxed as ordinary tax rate. Right? Losses offset gains with any net loss eligible to offset 3,000 of ordinary income. Remaining excess loss can be carried forward. I don't expect you to know that. Those of you that are an individual, you do know that, but that's why it's important. Make this character determination if it's a flow-through entity, because I might have individuals up there that need to report this income on their individual tax returns, and these attributes are important to them. Now, when I contrast that to the last row, a corporation, if it's ordinary income, it's taxed at 21%. If it's capital gain income, it's taxed at 21%. We have no preferential tax treatment at the corporate level for capital gains versus ordinary income. One tax rate, 21. It doesn't matter. So yes, I might do this analysis and everything, but it doesn't matter how I characterize it for the net results on the tax reform. If it's a loss on the ordinary side, then that offsets ordinary income at the corporate level. The trick on capital losses at the corporate level is losses are only deductible to the extent of gains. We're going to cover a lot of this in subsequent. Pulls it all together as to why character is important. Losses are deductible only to the extent of gains. Any loss, any excess loss is eligible for a special 3-year carryback, 5-year carry forward. I get to utilize the loss in an 8-year window, but I'm looking for capital gains in those 8 years to utilize that loss. Okay? That's why capital treatment is important. Whether it's gain or loss, not the rate component, but how do I use the loss to offset my tax bill. Okay. So Exhibit 3.4 in the textbook does a good job. This kind of summarizes it well, but it kind of goes through treatment of capital gains and losses by individual or corporation. Okay. The character of the gain or loss depends on the character of the asset that is being disposed of. Okay, which is determined by how the taxpayer uses the asset. It's not asset specific, it's how the taxpayer is using the asset. So the same asset might be a capital asset to me, it might be an ordinary asset to you. Okay, so it's not, you don't say this piece of machinery is an ordinary asset. Well, how are you using the machinery? Is it being used in the business or are you using it not in the business? So just be focused on how is it being used by the taxpayer. So our potential uses of an asset, it can be used as property used in a trade or business. It can be used as inventory. It can be held for property held for investment and personal use property. Those are the uses of the asset, right? You can do number 4, you just use it at night, on the weekend, it's your hobby, that's it. You can use it, your hobby goes into a business, right? It could be number 1. It could be inventory. So it comes into your business, you're selling it on a regular basis, right? That's how you make money. Or it could be held for investment. You're actually buying it on a speculative basis, hoping you can sell it for something. These are the uses of the business owner, of the asset in the tax code. Okay, another chart. There's a lot to be said with charts and how you put them, but you got to stare at them sometimes. So let me walk you through what I'm doing here. So the columns are potential uses of the property. So those 4 things: using it in a trade or business, it's inventory, held for investment, or personal use. And then I do the rows as the holding period. Short term and long term, with that 1 year being objective dividing line. So let's just walk through this. I'll take the easy ones first. Let's talk about inventory. Inventory, if I'm using that in my business and I'm selling, my inventory comes in and it goes out within a year, or for some reason I hold it for longer than a year because it's a long time to move the inventory, it doesn't matter. Inventory is all ordinary, right? That's business income. By definition, business income is inventory cycling through the business. There's no preferential treatment for that. Okay? Property held for investment. That is capital asset. By definition, you're holding it for investment. So this could be real estate you hold for investment. It could be stocks and bonds you hold for investment. The only nuance here is if it's capital and it's held for less than 1 year, short term, it's ordinary. Okay? It stays capital if it's long term. So it's always capital. You just have that if you're trading it, right? You're buying stocks on a day trading basis. That's all, any gains on that is always going to be ordinary. Okay? And personal use property. So this is stuff you're using in your personal life, your car, your home, your hobby materials, your whatever. All that stuff that we have in our lives that is not used for business is held for personal use. So that is capital in nature, taxes ordinary if you sell it within 1 year, and then capital if it's greater than 1 year. I put a footnote here in number 1. Remember that gain, you remember this with individuals, gain on the sale of personal use asset is taxable. So if you happen to have things you use in your personal life and you sell it at a gain, the government says, I'll tax that. Sell it at a loss, it's non-deductible. So it's asymmetrical treatment on that in favor of the government.
Do we have to worry about property that's held for sale?
I'd say it's the same as held for investment. Because I think indicative of the investment is you might exit it at some point as opposed to, now, that could be a long period of time, right? You might hold a piece of art for decades. But I think if it's not for personal use and it's held for investment, it's indicative that you might exit that. Okay, so I put in green where we're going to be focused on this course. I just want to give you the bigger picture. But in green here, we're going to hone in on what happens with property used in a business that is either short-term or long-term. If it's short-term, it's ordinary income. Okay? So if I buy a piece of machinery, I'm using it in equipment, I happen to exit that ownership within a year, ordinary income. Kind of a rare fact pattern. I would question whoever bought it. If I was running the business, why'd you buy it if you were going to sell it? But if I was going to hold it for longer than a year, I get into the special green box, section 1231 assets. That's what we're going to spend our time here talking about. 1231 assets. I put know where we're headed in the upcoming slides. Gain on the disposition of a 1231 asset is eventually characterized as long-term capital. What is long-term capital? That is the most beneficial I'm going to ever get. Why? Because I give more beneficial treatment to long-term capital assets, and by definition, capital assets get preferential treatment. And this is for individuals as well, right? And so loss on the long-term loss on a asset used in a trade or business held for more than 1 year is treated as ordinary. I like to think of 1231 assets. People call them 1231 assets because that's the tax code, obviously, where these rules are. But I think of it as the best of both worlds. If I had gain, what would I want it to be? Long-term capital. That's the best tax treatment I'm ever going to get. I held it for greater than a year. If it's a loss, what's the best I want it to be? I want it to be ordinary because it can offset ordinary income. Right? So 1231 assets are the best of both worlds. It's giving the best treatment for gains, the best treatment if it's a loss. How do I get there? It's property used in a trade or business held for 1 year. That's 1231 assets. I have to ask those questions each time I come into a property disposition for a business entity. Is it a 1231 asset? Okay, so that's where we're going to spend our time. So the intersection of that row and column is used in a trade or business held by a taxpayer greater than a year. Okay. Disposition of 1231 assets is afforded preferential tax treatment. If the disposition results in a gain, it's characterized as long-term capital, which is taxpayer favorable. In what instances? When it provides access to potential preferential tax treatment, that's only going to happen when I have an individual owner of a flow-through entity. Right? Because a corporation doesn't have preferential tax treatment on long-term capital. It's taxed at 21. But if I have a partnership or an S corporation disposing of a 1231 asset, if I'm distributing or I'm flowing through long-term capital gains, that's a good thing. My individual owner is going to be really pleased with that. They're going to have preferential tax treatment. Okay. If the disposition results in a loss, so my amount realized is less than my adjusted tax basis, realized loss recognized on my tax return, it's a 1231 asset, it's used in a trade or business, held more than 1 year, then that's treated as ordinary. That's going to be taxpayer favorable as it allows for the offset of ordinary income. Now that one is going to be important for the individual owner, right? Because they like ordinary losses, offset ordinary income. But it's also beneficial to a corporation. Remember when I said in this slide, ordinary losses fully offset ordinary income. If it were characterized as capital, I only deduct capital losses to the extent of capital gains. That's why it's the best of both worlds. I get the best answer for losses and the best answer for gains. Okay, let's show some of these in some examples. 3.5 is Lillian.
Teton sells land / property used in trade or business and held for over 1 year. This makes it a section 1231 asset. Now we're going to sell this land and we want to determine our gain and loss or loss. So we're going to be doing our amount realized minus our current adjusted basis. So that'll be 175K minus 75K. This gets us a $100,000 gain, which is due to the character of the property, a section 1231 gain.
So let me pause you there. So what she went through, you got to methodically go through that, right? Compute the gain or loss. Amount realized. Go through that exact little chart that I had. Did I capture all that? Did I get that right? What's my adjusted basis? I need to know, did I get the depreciation right? That's my realized gain or loss. Is there anything that doesn't put it on the tax return? No, then it's recognized. What's the next step? Characterize that gain or loss. Right? So just, if you start with characterization, you're not going to get to the right answer. So just don't get lost in the facts. When you get, and I'm not just teaching for the exam, I'm teaching for real life. Don't just start grabbing on facts. Sit back and look for it. It's like, oh, okay, I have a disposition. What do I first do? Amount realized. Let me go through and collect all that. Basics. Go through that. Get to the amount. Now I got to characterize.
Now, assuming that Teton sold the land for $50,000 instead, our $25,000 loss would once again be characterized as a section
costs because of the character of the asset. Now assume that this asset was the only one that's even sold throughout the year. It would then be characterized as a long-term capital gain, if it's a gain. And if it is a loss, it's 1231, and it would then be characterized as ordinary.
Yeah, as you mentioned, just simple test, is it a 1231 or not? Is it used in a trade or business held for during the year? Then I get the best treatment possible on the gain side of the asset. Okay. So, 1231 assets, I have to deal with depreciation. Okay? So, when I determined my adjusted tax basis, right, it was initial basis less accumulated depreciation, it's to adjusted tax basis. So, some of my gain can be attributable to reducing my initial basis down to adjusted tax basis, i.e. my prior depreciation deduction. Depreciation recapture, what it effectively does is prevents asymmetrical treatment whereby prior depreciation deductions reduce tax at ordinary income tax rates, because depreciation deductions, stuff we went through in the prior chapter, is all going to be put on the tax return and reduce my ordinary income, right? So it's lying on page 1, reducing taxable income. So that cost recovery reduced taxable income at ordinary tax rates. Then if I turn around and sell that property and I generate a gain, a portion of which was created merely by reducing my tax basis by accumulated depreciation, if I gave that full gain access to capital treatment, it might be taxed at a lower tax rate because some of it is flowing up to an individual owner who is taking preferential tax treatment. So depreciation recapture is just simply saying portion of the gain could be just attributable to prior deductions that reduced ordinary income. Therefore, I got to take that character of the gain and recapture it as ordinary income, with any excess potentially being any gain in excess of prior accumulation being true economic appreciation of being afforded long-term capital. Okay, so it only applies to changing the character, not the amount of the gain. I already computed the gain in those first couple steps. Now I'm just looking at character. So I think it sounds weird because depreciation recapture, but what it's doing is restoring the prior depreciation deductions and says those went through ordinary income, so this gain has to now be recaptured as ordinary income to the extent of those prior depreciation deductions. Importantly, depreciation recapture does not apply to sales of property at a loss. So if I do those first few steps and I got a loss, I'm not dealing with depreciation recapture. Not in that world. This is only gain. I'm trying to take gain into ordinary. Okay. Although it's really complicated because there's 3 specific types of depreciation recapture. They all kind of work the same, but we're going to be talking about what is called 1245 property, which is really personal property used in a business. This is not personal use property. This is not stuff you're using in your personal life. This is personal property, which means it's all property that's not real property, not real estate. Machinery, equipment, office, furniture, fixtures, computers, those types of things. That's all personal property used in a business. Okay. Gain from the sale of personal property used in a trade or business to the extent the gain was created by prior depreciation deductions is recaptured as ordinary income, as I mentioned. The amount which is treated is the lesser of the gain realized or accumulated depreciation on the asset. Okay? That just keeps me to treating the true economic appreciation as capital. Okay? And any gain afforded 1238 or 1231 treatment is remaining gain after I recapture depreciation. What?
Sorry, just to take you back. So there's a distinction between personal property and personal use property. Right?
Yes.
So personal property is basically non-fixed assets.
Non-real estate.
Non-real estate.
Non-real estate.
In the business.
Personal use property is your stuff, your things, right? That are not related to the business. Okay. That's important. I always found that confusing. What do you call personal property? It's not being used by a person, but all it's trying to do is say it's non-real estate, non-real So when you're looking at this, there can only be three things that can happen in depreciation recapture. So you can have your gain created solely through depreciation deductions. Like the only reason you had a gain is because your basis went down to get to adjusted tax basis. That's what caused there to be a gain. So all the gain's gonna be recaptured. Now, secondly, it could be through both depreciation deductions and actual economic asset appreciation, right? Some of my gain was because I pulled my basis down, right, recovered depreciation, but the property also increased in value economically. Okay, I could have that scenario. And then I could have a sale at a loss. Okay, let's do the first example here, 3.6. Did anybody do 3.6? Nobody wants 3.6. The last 4 minutes.
I'll just do it because I missed. I was in class the last one.
All right.
So, as indicated in Exhibit 3.2, Teton sold machinery for $300,000. What are the amount and character of the gain Teton recognizes on the sale? $71,342 of ordinary income under the depreciation recapture rules that we just went over, and $0 of the 1231 gain completed as follows. And this table kind of shows, no pointer stick, but basically how we calculated it. We took that original basis minus the accumulated depreciation. Then for the gain or the loss recognized, we took the amount realized minus that adjusted basis. And basically for the ordinary income, we took the lesser of either the accumulated depreciation or the gain or loss recognized.
Yeah, so we first computed the amount, right? Amount realized, adjusted basis, so we kind of would have worked through that. We got down to 71,342. That is now going to be recognized because we found there's nothing that's going to exclude it or defer it from this year's tax return. So now it becomes character. And we know that this one was depreciated, so we have to deal with that depreciation recapture. And so it's the lesser of rule. It's the lesser of the gain realized or the accumulated depreciation. And so my gain realized is 71. My accumulated depreciation is 381. Obviously, the lesser of is 71. 71,000 is entirely ordinary income. Okay? And the reason we have this, right, is because the depreciation that caused the gain reduced ordinary income. I don't get the best of both worlds of reducing it and then turn around and have a gain that might be taxed as a capital if it flowed through to an individual fund. Okay? That's the concept of depreciation recapture. And so I'll leave it with that for this, and we'll pick up with the rest of this. But this is the crux. 1231 is what you need to know in the business entity context for property disposition. Okay. All right. I'll see you tomorrow.
Locked in, man, locked in. I'm ready to come back. Not back. Not ready to come back. I don't know, because I'm just tired. Like, it's been a long. Yeah, well, it's not even just that. It's like, because right now I'm at work, like, making a new model. So I've just been looking at, like, numbers just, like, all day, and then here's numbers, and it's just like, oh my god, I have to look at it. He actually helped me with something, like, earlier today, so that tax rate, sign sheet, what we did with that. Yeah, but, that test I showed is just... Well,
now we know what to expect, to be honest.
that's not good. I don't want to expect that. I don't want every test to be like that.
But at least to know what.
Yeah. I know I'm not going to need a textbook once you do problems. Textbook's not help.
So it's a great.
I honestly could have not studied. I don't think it would have been.
Man, I'm tired already, bro.
Yeah.